Mark Edwards is asking, Oliver, if you submit your limit order close to the 20-period moving average, but that value would violate your 50% rule, should you not trade close to the 20-period moving average there? So I think what this trader's asking is, here my stock has moved up, and here is the 20-period moving average down here. That's the 20-period moving average. And the stock pulls back to the 20-period moving average, but that point at the 20-period moving average is actually below the 50% mark. And the pullback to the 20 is past the 50% level. Should you take the trade off of the 20-period moving average? This is going to be a lower odds play because the drop is so deep. Think of this as being a wall that now the stock has to climb this tall wall to make new highs. But it's greater odds of the attempt failing. All right. The walls that you want to climb you want them to be smaller, like this. Now, from there, the wall to climb is not that great, but from here, the wall to climb is great. And therefore, the odds of climbing all the way to the top of a tall wall is lower than the odds of climbing to the top of a small wall. All right. So we want our walls to be small, not great like this. All right. That's a big wall to overcome. And this is a small wall to overcome. If your stock is even pulling back to the 20, what this means is that this run up was so big that the drop even back to the 20-period moving average is a steep drop because it's coming from such a big high, a tall high, and declines from super far tops typically fail. The secondary attempt typically fails because the fall is so great. So think of it this way. If you were to stand at the top of a building, let's say that's the top of the building. Let's say this building is 40 floors. Now, you're at the top of this building and you throw a ball down the building to hit the pavement. That ball hits the pavement down here. Boom. That ball's odds of coming all the way back to the 40th floor is very small. Maybe the 10th floor, maybe the 15th floor, boom, and fall back to the ground. Right? Why? Because the ball fell from the 40th floor. The drop was too great to overcome on the bounce off of the pavement. However, what if this is the second floor? Now you throw the ball down. You have higher odds of the bounce even going higher than the second floor. So the point is that the bigger the drop, the greater the odds that the next attempt fails. The more controlled the odds are higher that you get a successful attempt. But here, now you fail. If you're falling from a great height and reaching the 20-period moving average below the 50% point, that means your drop is huge. And that bounce is likely going to be short-lived and fail. It's what I call the dead cat bounce. I love cats, guys, so don't take this literally, but the dead cat bounce theory is this. If you drop a cat from the top of a tall building, the cat hits the pavement and is instantly dead. The body of the dead cat might bounce, but that doesn't mean that the cat is alive. The body bounces off the pavement, and then the body falls back to the pavement. That's a dead cat bounce. I love cats, guys. Don't take it literally, please. But if you drop, boom, a cat, and that cat comes way past the 50% mark, that cat's alive. And you better run, because it's not happy. It's coming to get you. All right. So dead cat bounce, usually halfway, and failure. All right. There's the smack to the pavement. There's the dead carcass bouncing, but it's dead. It's going to fall back. Be careful of buying sharp, big declines. You want your declines to be more controllable, like almost like a hang glider gliding off of a mountaintop. You don't want a fall, you want a glide. Boom. All right. There's a very big difference. There's an art in knowing what pullbacks to buy into, the glides you buy into, the very controllable ones. Look at this glide. Look at this. Very controllable. It's not a collapse like that. When you get the collapse, it's usually the secondary attempt that has the higher odds, like this. So you get this drop, and that one has the better odds. This one fails, and this one has the better odds of going. Here, we drop hard here. This is a hard drop here. Boom. Failed attempt. The second one goes. The second one on your sharps. Boom. That second one is your play. This one is a trap most of the time. So let's say here's your 20-period moving average, and here is your stock is far away from the 20. I'm always teaching my traders, when you separate away from that 20, that's a profit-taking surge away from the 20. When you accelerate away from the 20. But can you go the other way? It depends, not always. It depends largely on the maturity of this move. So where did the move start from? Is there time and space? We have space away from the 20-period moving average, but do you have time? So for instance, if your stock starts here and then goes there, maybe that's not a good short, even though it's far away from the 20, because you don't have time. See? There's the best shorts against the trend have both time duration in the trend and space. So it looks like this, guys. Take a look at this. You've got time duration in the trend, and you have space, right? So your stock has been going for a while and then surges, right? So now you've got time in the trend. It's not early in the trend. It's kind of late in the trend. And you now have space away from your key moving average. When your time and your space are roughly equal, they don't have to be exactly equal. So when this arrow is relatively equal to this arrow, it's time. Your time in picking a moment to go the other way is better than over here with very little time. I hope that didn't confuse most of you, but I teach my traders this time and space concept for timing some really amazing trades with that concept. There are 4 dominant time frames, 4 dominant ones that I teach my traders, to 4 windows: 2-minute, 5-minute, 15-minute, and daily time frame. All right. They're not the only 4 time frames, but they're the 4 dominant ones that my traders look at. So 2-minute, 5-minute, 15-minute, and the daily chart. All right. The daily chart and the 15-minute are used as advisors. They advise you on the odds of your play having flow. Okay. I'm not going to go into the details, but they're advisors. They don't pick the play. The 15-minute and the daily do not pick your play. Your 2-minute or your 5-minute, these 2 time frames are your trade pickers. They pick the play. These advise on the play. They never pick. All right. Now, do you choose a 2-minute to pick or the 5-minute to pick? That is your personal choice. My traders, during their developmental period, they're going to use the 2-minute chart, because the 2-minute chart gives them, as Nicole mentioned, gives them more trading opportunities. And remember that you can't learn how to do this unless you're inside of trades all the time. Like, you can't learn how to do this listening to me. It helps, but it's not progress. You can't learn how to do this reading a book. It helps, but it's not progress. You can't learn this in a seminar. It helps, but it's not progress. Progress can only occur inside of real trades. The moment you enter a trade, tick, 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 your progress clock is ticking. The moment you end the trade, there is no ticking. You can read until you go blind. You can study charts until your eyes go bad. You're not making progress. That clock doesn't start ticking until you enter the next trade. You're quite obviously, you're going to find more trading opportunities on a 2-minute chart than on a 5-minute chart. So if the first goal is to become as experienced, if the first goal is to get 10,000 trades under your belt, don't you want to do that faster than slower? This is why traders have something going against them right from the start, and it is their desire to make money first. This is a problem, but of course we all understand that the whole objective of trading is to make money, but it can't be the objective first. The first objective must be to become experienced. It's a big difference, because this experience requires loss. You can't become experienced just winning. You must have wins. You must have experience getting destroyed. You must have experience losing. In fact, you have to have more experience losing than winning. You have to put losing behind you. Do you understand? You have to go through loss. You have to become intimate with every possible mistake a human being can make so that it gets behind you. This desire to be profitable right from the start is what contributes to the high failure rate in trading, because it is impossible. Your success is on the other side of experience, and experience must be both winning and losing, but mostly losing. If someone told me this when I was struggling, maybe I wouldn't have been so depressed. Maybe my hardship wouldn't have, that cross that I had to bear wouldn't have been so heavy. If someone told me that I was supposed to lose, that this is how you rise, you must squat before you leap, You must go backwards before you jump forward. I didn't know that. I didn't know that every single loss was moving me closer to being the master trader that I wanted, that I was becoming so intimate with every mistake that actually naturally they just started to fall away. That I stopped being afraid of losing because I lost so much, that it lost its grip on me, that it stopped scaring me, it stopped spooking me, it stopped making me depressed, because I've been there, done this so many times. I'm tired of being depressed about it anymore. I went through the loss. I wish more traders understood that you're supposed to lose in the beginning. Just like a baby is supposed to fall in the beginning while learning how to walk. It's impossible not to. You can't be good before you become experienced. And you can't become experienced unless you have gone through thousands upon thousands of losing trades. Guys, this game is a game of twos, right? You've got two directions up and down. You've got two transactions, buy and sell. You've got two results, win and loss. My traders have two moving averages, the 20, the 200. You've got two states, narrow and wide. You've got two locations, above the moving averages or below the moving averages. It's a game of freaking twos. I tell traders all the time, stop overcomplicating this thing. If you can count to two, you can do this. But if you start to count beyond 2, 3, 4, 5, 6, you're overcomplicating the game and you're making this a lot more difficult than it needs to be. All right? It's a simple game. We have to stay simple.